Good afternoon and welcome to lecture 27 of ETC 779. In this class, we are going to learn about the formal accounting procedures. In the previous lectures, we have tried to analyze profit and loss account as well as balance sheet through an informal manner. That is not the way in which accountants approach the problem. So, in this particular class, we are going to learn a systematic way through which the accountants in real life situation, they prepare the financial statements such as profit and loss account and balance sheet. Now, if you remember, profit and loss account is also known as sometimes income statement. So, in this class, I will just quickly summarize what is meant by cash book, what is meant by TAccount or ledger, what is journal, and then straight away we will take a small problem and we will list out all the steps in a sequential manner, and then I will show you how to prepare the profit and loss account as well as the balance sheet. So, this is the objective of today's lecture. So, we straight away move to the accounting systems, then we have to discuss the cash book, journals and ledgers. Now, before starting, just try to recollect the conventions that we had used for recording various transactions. This has already been deliberated upon in previous lectures. So, just to get you started, I will just quickly summarize. For example, if there is an increase in asset, you record it under debit side. Similarly, if there is an increase in liability, you record it under credit side. Likewise, if there is an increase in expense, we record it in debit side. Similarly, if there is an income increase, we record it in credit side. Now, the reverse of all these statements will be recorded in just the opposite manner. For example, if there is a decrease in asset, we record it under credit side. If there is a decrease in liability, we record it under debit side. If there is a decrease in expense, we record it under credit side, and similarly if there is a decrease in income, we record it under debit side. Now, this is a typical cash book. I have already discussed that there are broadly two kinds of transactions that we have. One, you have cash transactions, and another you have got non-cash transactions. You remember that cash transactions are recorded in cash book initially, and then they are subsequently transferred to T accounts and then subsequently to other financial statements. So, a typical cash book has debit and credit sides. Increase in cash is recorded in debit side and decrease in cash is recorded in credit side. So, if you look at this particular slide, this is a cash book, typical cash book. It has debit side, it has a credit side. So, what does this cash book essentially do? It basically gives you two information. One, it records the transactions in a sequential manner, that means in chronological order. Then second, at any point of time, if you would like to know what is the cash balance with the company, you will be able to find it out. I have given a very small example in which the capital is 300,000 and the bank loan has been taken as 400,000. So, the total amount under debit side works out to be 700,000. If you look at credit side, this amount has been utilized in purchasing the building as well as equipment. Building cost is 400,000, purchase cost, acquisition cost, and if you look at the equipment, it has costed the company 200,000. Now, just under this transaction, you will find a term called balance carried down. So, this particular amount is written over just to equalize the two sides, debit as well as credit. So, now if you add this balance carried down of 100,000, you will find that the total credit amount also is equal to 700,000. Now, by doing so, accountants become happy because now both the debits and credits are matching. Now, just under this debit side, you will find that a statement is written balance brought down. B/D is nothing but balance brought down. So, whatever was the difference is written over here as balance brought down. So, that means as of this date, the company has a cash balance of 100,000. This is what we discussed, that cash book gives two information. First, it organizes all the cash transactions in a chronological manner, and second, it gives you the cash balance existing at any point of time within the company. Now, we will quickly move to a typical T account. T account is also known as ledgers, right? Now, the name T is because it is of a T shape, so that is why it is known as T account. Now, suppose I want to write the transactions in buildings T account. Normally, each of the items or assets or liability heads will have a separate T account or ledger. There you record all the transactions related to that particular item or that particular head. So, this particular T account is for building T account, in which you might notice that under debit side a transaction building purchase for 100,000 has been recorded. Why it has been recorded under debit side? Because our convention is to record increase in asset in debit side, and that is what it has been shown in this particular example. Suppose there would have been decrease in asset, then that could have been written under credit side. Increase in expenses would be written under debit side. So, this is just a case of a typical T account in which I have given you a building T account, in which since there is an increase in asset by an amount of 100,000, it is being written under debit side. Had it been decrease in asset, I would have written it under credit side. If there would have been an increase in expense, as I told you, there are different T accounts. There could be T accounts for building, there could be T accounts for capital, there could be T accounts for bank loan, there could be T accounts for equipment, there could be T accounts for purchase. So, whatever major heads you have under which you want to record the transactions, for that you have to have a separate T account or ledger. Now, we will quickly move to a typical journal. As you know, journals are primarily used to record non-cash related transactions. Suppose you are dealing in some credit, suppose you have purchased some materials and you have not paid to the supplier in cash. Similarly, if you have made sales for a particular commodity or maybe for some item, then and you have not been paid in cash, so such transactions you record it in journals, right. So, all non-cash related transactions are recorded in journals. Now, there are two types of transactions here again. One which you need to record the moment the transaction has taken place, and the second one is known as adjustment entries. For example, there could be wages, there could be depreciation, all such things we normally take care in the form of a adjustment entries. Because if you try to incorporate all these things, for example wages, for example depreciation, you will find that the accountant's job would become extremely difficult. So, in order to avoid such things, what normally accountants do is, whenever you require the balance sheet and profit and loss account to be prepared, at that point of time you have adjustment entries. So, that you record it in journals, appropriate journal entries are made for adjustment entries, and that you subsequently close and then take it to profit and loss account and balance sheet as and when needed, right. So, that we will see when we go through a small example. Now, this also we have discussed in principle what are the different steps involved in the accounting processes. For example, once the transaction has been initiated, you start writing it. Now, you don't record the transactions until and unless you have some supporting documents available with each of these transactions. The supporting document could be in the form of invoice, could be in the form of a bill, it could be in the form of some written document, it could be email, anything. So, until and unless you have got some supporting document available to you, you don't initiate the transaction. That means you don't take care of that particular transaction. Now, the step 2, what accountants do, they go on recording these transactions in a chronological manner. When you say chronological manner, that means they are written as and when they take place. For example, it would be recorded for 1st August, 2nd August, maybe 5th August, 10th August, like this they go on recording it. Now, there also while recording, you record it at either in the cash book or you record it in journal, depending on whether the transaction is cash related transaction or whether it is non-cash related transaction. Now, as I was discussing just a while ago, the adjustment entries are also to be recorded, but not on a daily basis, but these are required only when you have to prepare the profit and loss account as well as balance sheet. So, I was just telling you about this first 3 steps. In a step 1, you have to initiate the transactions, that you don't do unless until it is supported by relevant documents. Documents could be invoice, document could be sales receipt, document could be challan, delivery challan. Now, all these transactions you record it in a sequential manner, in a chronological manner. The transactions could be of 2 types, cash related transactions and non-cash related transactions. Cash related transactions you post it in cash book, non-cash related transactions you post it in journals. Then we discussed about adjustment entries, which are recorded only when you have to prepare the profit and loss account. Suppose you want to prepare the profit and loss account for a particular period, maybe from 1st of April to 30th of June, and similarly you want the balance sheet as of 30th June. So, you will be compiling your adjustment entry as on 31st June or 30th June. The day at which you require these 2 financial statements, on that particular day you have to keep it as a cut-off date and accordingly make different adjustment entries. We will see what are the different adjustment entries with the help of a small example. Now, once you have recorded the cash book, recorded the entries into cash book and journals, they are subsequently transferred to T accounts. Now, normally these shifting of transactions from cash book and journal to T accounts do not take place on a daily basis. They may take place on a daily basis if the transactions involved with the company is too large in numbers. But for a small company, it may be recorded on a weekly basis. The idea is whenever you have got substantial number of transactions, you start posting it in different T accounts or ledgers. Once you have recorded these transactions in different T accounts, you start preparing the initial trial balance. We will see what are the different components of initial trial balance. And then finally, from these trial balance, you transfer the expense and revenue related items into profit and loss account, and then you calculate how much is your profit. Then those profits are suitably appropriated. Maybe the company might have planned to declare some dividends, and the remaining amount it wants to keep it with itself as retained earning. So that means profit is appropriated, and then finally you close other journal entries or other T accounts entries involving assets and liabilities, and that is taken to the balance sheet. So all these 7 steps we will try to go through with the help of a small example. Now I have taken very few transactions just to illustrate you the process in a very quick manner. So let's say there is a company which has been started by David. The name of the company is the Precast Company, and David has provided rupees 300,000 as the initial capital. So this is as far as transaction 1A is concerned. So you may find T1A notations used by me. Then the bank provided a loan of rupees 400,000 to the Precast Company. So first transactions related to capital. So David provided initial capital of rupees 300,000. In second transactions, on the same day you will find the bank provided a loan of rupees 400,000. Now in the third transaction, the Precast Company bought a building for rupees 100,000, equipment for rupees 250,000, and furniture for rupees 50,000 paying cash. So that means whatever cash it has accumulated is going towards purchase of building, purchase of equipment, and purchase of furniture. So this whole transaction I have given the name T1C. Now if you look at the fourth transaction, by the same evening, that means on 1st August itself, the Precast Company was all set to start production and bought rupees 150,000 worth of construction material, paying cash. Now these materials are enough for 3,000 numbers of precast panels. So this is the fourth transaction. What the company has done, it has purchased construction materials worth rupees 150,000, all in cash. So you might have noticed that in this particular slide, all the transactions are cash related transactions. We have not taken a single transaction in this particular slide which relates to non-cash transactions. We will see some more transactions, but I hope by now you must have copied all the 4 transactions given to you. Just to summarize, capital 300,000 provided by David, bank loan of rupees 400,000. The company bought a building for rupees 100,000, equipment for rupees 250,000. Company purchased furniture for rupees 50,000, and the Precast Company also purchased construction materials worth rupees 150,000, paying cash, and this material is enough to produce 3,000 numbers of precast panels. Now we move on to next slide. It gives further transactions details. For example, on 5th August, if you see, by this date, work on 2,000 precast panels was half complete. On 10th August, the Precast Company completed 1,500 numbers of precast panels. Another 500 were half complete. On 30th August, the Precast Company sold 1,000 numbers of precast panels for rupees 120,000 on credit. Sorry. So this is as far as transactions T1E, T2 and T3 are concerned. In T1E, by August 5th, you find that work on 2,000 precast panels was half complete. On 10th August, the precast company completed 1500 numbers of precast panels. Another 500 were half complete. On 30th August, company found that it has sold 1000 numbers of precast panels for rupees 120,000 on credit. Now, some more transactions are given. On 31st August, the precast company paid rupees 4,000 to the bank as interest and rupees 9,000 as income tax. Next transaction on the same day, the precast company estimated that the depreciation on fixed assets for August was rupees 6,000. And finally, the last transactions on the same day, that is 31st August, the precast company declared and paid rupees 15,000 as dividends. So these are the sets of different transactions entered into by the precast company. Now, what you have found here is that the transactions are all recorded in a chronological manner. So, step 1 is done. Step 1, if you recollect, it was to initiate the transactions. So, all these transactions are initiated because all these transactions are supported by valid documents. We assume that all these transactions are supported by valid documents as of that particular date. Now, what we do, out of all the, suppose now the transactions have become substantial and now I want to post it. Now, out of these transactions, I have to see what transactions will be recorded in cash book, what transactions will be recorded in journal, and what transactions need not be recorded. So, 3 informations. First, which are the cash transactions to be recorded. Second, which are the non-cash transactions to be recorded in journal. And third, which are the transactions that we don't need to record at all. Let's move on to some more information. These are related to this problem. On 31st August, the precast company valued its stocks. That means the company is now interested to prepare the profit and loss account as well as balance sheet as of 31st August. That's why this exercise has been carried out. The company has found that it has got raw materials worth rupees 50,000 still with the company. Work in progress valued at rupees 32,500 and finished goods equivalent to rupees 40,000. Now, some more information is given. Each precast panel requires rupees 50 of materials and rupees 30 worth labor. Now, this last information is used to arrive at the value of work in progress. Suppose the work is half done on one panel. The entire material is consumed, so rupees 50 gone. But as far as labor is concerned, only half the work is done. So, I will take 30 divided by 2 in order to account for 50% of labor. So, my work in progress, if only one item is under progress, becomes rupees 50 plus 30 by 2, that is equal to 65. So, that is how we calculate the work in progress. That means how much material has gone inside to produce that panel, how much labor has gone inside as of that particular date in order to produce that many numbers. So, that is how we calculate the work in progress. So, using the same principle, the company has been able to identify what is the raw material stock, what is the work in progress stock, and what is the finished goods stock available with the company as of 31st August. Please note this, because if we were not supposed to prepare the profit and loss account and balance sheet as of 31st August, this exercise the company may not have done or would not have done. So, this point you need to note, and you will also find that in subsequent discussions that these informations are part of our adjustment entries. This is what we were discussing a short while ago, and that we will see how to apply it in real life problems. Now, while recording the transactions, if they are cash related transactions, we discussed that they are to be recorded in cash book. So, now you will find that this particular slide gives you all the cash related transactions detail for the company. For example, on August 1st, if you look at the debit side, capital amount is 300,000. Now, if someone has given initial capital to the company, what has been done? There has been an increase in cash from 0 to 300,000. Now, cash is an asset. So, what has been achieved through this transaction? There has been an increase in asset. Now, if you see your convention, increase in asset is to be recorded in debit side. So, that is what has been shown here. I have shown two transactions under debit side. One is capital, amount is 300,000, then another one is bank loan, 400,000. Remember, we are recording it under cash book. Cash is an asset. So, any increase in cash, I will be recording it under debit side, because my convention is to record all those transactions involving increase in assets under debit side. Now, look at the right hand side, which shows the credit part. Here you will find that wherever the cash has been utilized or wherever the cash has been spent, what will be the effect of spending the cash? It will reduce your cash asset. That means these are associated with decrease of assets, and as per your convention, decrease of assets is to be recorded in credit side. So, you find building for an amount of 100,000 is recorded under credit side. Equipment, it has been recorded under credit side. Why? Because for purchasing all of them, I have spent money. So, this in turn has reduced or decreased my cash asset, and accordingly it has been recorded under credit side. Now, you look at the other transactions. Furniture, I have spent 50,000. So, there is a reduction in cash. So, I have recorded it under credit side. Purchases, here again I have purchased the material in cash, paying cash for rupees 150,000. It has been recorded under credit side. Interest, again it has been going out of the cash balance of the company. So, again this will be part of decrease in asset. So, it has been recorded in credit side. Income tax, again it is going out of your cash bank. So, it has been recorded under credit side, because that will also reduce your cash balance. Dividends, again it is going out of the total profit earned, and accordingly it is shown under credit side, because in this particular example it is assumed that dividend is paid in the form of cash. So, there has been a reduction in cash. So, reduction in asset. So, it has been recorded under credit side. Now, Just ignore the last line for the time being under credit side. You will find that the debit sum is totaling to 700,000, whereas if you look at the credit sum, there is a difference of 122,000. That means right hand side without the last line will be equal to 578,000. What does this mean? These are not balanced. So, in order to balance the debit side as well as the credit side, you enter a figure of 122,000 under credit side. Now, we were just discussing about the shortfall under credit side. So, if you sum it up in debit side, you will get a figure of 700,000. Just try to look at the debit column amount. 300,000 plus 400,000, it is equal to 700,000. Now, just ignore the last line of the credit side, balance carried down. If you ignore that, you will get a value of 578,000. That means they are not balanced. That will make an accountant an unhappy person. So, what they do? They simply write a line balance carried down and equate it to 120,000, 122,000. What will this do? Now, they will match debit amount as well as the credit amount. So, now accountant is happy because his debit sides and credit sides both have matched. Both are coming equal to 700,000. Now, whatever balance carried down was written under credit side, that is brought down under debit side, the same amount. Now, what does this 122,000 mean? It means that as of this particular date, the company is having a cash balance of rupees 122,000. That means this much money is available in the cash box of the company. And this is what we discussed right at the beginning, that cash book gives you two informations. It records all the transactions, cash related transactions in a chronological order, and second, it also gives you the cash balance at any point of time. So, this is what has been achieved in this particular example. Now, we go to non-cash related transactions. You will find that there are very few non-cash related transactions. In fact, before August 31st, only one non-cash related transaction has taken place. That is, the company has sold 1000 numbers of precast units for 120,000, and it has not got money in cash. So, there are debtors of this particular company. Now, debtors are nothing but your assets, because the company owns this. So, if you recollect the typical journal format, it gives you information both on debit as well as credit part. So, under debit the debtors are coming, and under credit the sales is coming. So, that means there has been a sales of 120,000 in, not in cash, but someone owns that money to the company, or rather someone owes the money to the company. So, what is done? Increase in asset, same nomenclature, same convention. Increase in asset, debtors are asset. By doing this transaction, the debtors value has increased from 0 to 120,000. So, increase in asset, and accordingly it has been recorded in debit side. Now, since we require the two financial statements as of 31st August, we are including journal entries J2 and J3. Now, if you look at journal entry J2, it deals with depreciation. Now, depreciation is an expense. Now, increase in expense is to be recorded in debit side, and accumulated depreciation for that particular month. Accumulated depreciation is the sum of the depreciation for that particular month added in the sum of previous months. Now, accumulated depreciation is liability. So, you find here that depreciation is recorded under debit side and accumulated depreciation is shown under credit side. Just to give you the background, we were discussing on journal entry J2 shown on your slide. The first part already we have explained. In journal entry 2, you might notice that depreciation is shown as 6,000 and accumulated depreciation is shown as 6,000 under credit side. Now, we were discussing that depreciation is an expense. Now, as per our convention, increase in expense is to be recorded under debit side. So, accordingly it has been shown here, and accumulated depreciation, which is nothing but the sum of this month's depreciation plus the cumulative depreciation till the previous month, is nothing but a liability. So, increase in liability you record it under credit side. Similar logic you can apply for journal entry J3, which deals with wages. Wages is an expense. Increase in expense is to be recorded in debit side. Accrued wages is the liability of the company. The company owes it, so it has to be recorded in credit side. So, accordingly 52,500 has been shown under credit side. Now, remember, the August 31st transactions as far as depreciation and wages are concerned are compiled here only because we want profit and loss account and balance sheet as of 31st August. If these two statements were not required as of this particular date, we would not have entered these values in our journal. So, these are the adjustment entries. Now, we move on to some other step, which is recording transactions in TAccounts. So, what are the different steps we have covered till now? Step 1, initiating transactions. Step 2, recording transactions in chronological manner. Step 3, adjustment entries. And now step 4, we are transferring all the cash book entries as well as journal entries into the respective T accounts or journal or ledgers. So, we will have T accounts for different heads. For example, there would be a T account for cash. Now, there is a peculiar thing about this. Cash T account is nothing but a cash book. You will find that if you try to make the cash T account, you will find that it is nothing but the cash book itself. But still we will have cash T account, we will have capital T account, we will have bank loan T account, we will have building T account, we will have equipment T account, we will have furniture T account, we will have purchases T account, we will have depreciation T account, accumulated depreciation T account, wages T account, accumulated wages T account. Like this, we will have different T accounts. Now, our aim is to transfer each of the recordings in cash book as well as in journals to these T accounts. Now, for one or two, I will explain you how it is to be done. For example, if you want to prepare the T account for, let's say, capital. Capital T account. So, for this what you have to do? you have to go to cash book, because capital was provided to you in the form of cash, right? So here also you will have a debit column, debit side, and here you have credit side. Now what has happened with the transaction that David has provided a initial capital of 300,000. By this transaction, the company's liability has gone up. When this amount was not received by the company, the liability was 0. Now liability has increased from 0 to 300,000. What does this mean? There has been an increase in liability for the company by this transaction. Now increase in liability, you record it under which side? Under credit side. So this is how you will record. There could be a reference here. Reference number could be C1, anything. Now this is under cash, because capital you got it in form of cash and for an amount of 300,000. So the total here is 300,000. So this is how I have transferred capital part into the capital T account. Likewise, I will go on doing it for other transactions also. For example, I take bank loan, another ledger. Here again, you have a debit side, you have a credit side. Now same logic, bank loan before this transaction was 0. So as far as loan liability is concerned, the company had 0 liability. Now the company has taken a loan of 400,000. So liability has gone up. It has increased from 0 to 400,000. Now increase in liability, you record it under credit side. So here you have, again in cash, you received 400,000. So total 400,000. Now you may notice that it is taking the shape of T, and that is why it is known as T account. So if you just neglect this part, it is some sort of a T, and that's why it is also known as T account. Likewise, we have to prepare T account for all the heads which was given in either the cash book or in journal. So for example, just try to do it for buildings T account. Now building is nothing but your asset for the company. So just try to transfer that entry from the cash book in this particular T account. Left hand side conventionally you write debit, right hand side conventionally you write credit. Now the company has purchased building for 100,000. How will you record, and which side you will record? Before this transaction there was no building asset, its value was 0. Now the company has increased the building asset to 100,000. So what this transaction has done? It has increased the asset value. Now increase in asset, where do you write? We write it under debit side. So here you have cash for 100,000. This is the amount here you write. So, total here is 100,000. Now, suppose I am giving you one additional example. Suppose part of this building you have sold for rupees 50,000. That is not part of this problem, but I am giving you just to explain you some more concept. Suppose this particular thing was done on 1st August. The company purchased the building on 1st August for 100,000. Suppose the company has sold part of the building on 5th August for 50,000. How will you record this in this T account? Sales of building, part of building has reduced the building asset value. That means there is a decrease in building asset. Now, decrease in asset you record it under credit side. So, you would have recorded it here. Under credit side, you will say cash, maybe you can write part building sales. And the total of this credit side becomes 50,000. I will tell you how to balance them. But before this, we want to transfer all our cash book transactions as well as journal transactions into different T accounts. So, likewise, I will just show you how for other things the T accounts have been made. Just if you look at this particular slide, just under the building, I have given it for equipment. The company has purchased equipment worth rupees 250,000. So, what this transaction has done to the company? It has increased the equipment asset. Now, increase in asset is to be recorded in debit side. So, it has been recorded accordingly 250,000. So, this whatever exercise we are doing, you can do it on your own. I will try to go a little faster now. Now, we move on to next, furniture. Again, the company has bought furniture for rupees 50,000. So, this has increased the furniture asset. So, increase in asset, it has to be recorded in debit side. Accordingly, it has been written. Now, purchases. If you remember, on some particular date, the company has purchased material worth rupees 150,000 in cash. That means there has been increase in asset. Now, your construction material has gone up from 0 to 150,000. So, increase in asset, I record it under debit side, and accordingly it has been shown here. Now, we will move on to some more interest. Now, interest is an expense. Why? Because you are paying it for use of the capital. In the form of bank loan, you got the capital. Now, this is the payment towards utilizing that money. So, it is an expense. You need this expense for producing some goods which you can sell and earn profit. So, these are part of expense, interest. Now, increase in expense, you record it under debit side. So, 4,000 which has been paid in cash is recorded under debit side. Then you have T account for income tax. Again, this is an expense. Increase in expense, I record it in debit side. Accordingly, it has been shown here. Now, we move on to some more dividends. In the bracket you may see profit and loss appropriation. This term we will discuss little later. For the time being, just understand that this is also some sort of expense, because you have earned some profit and part of that profit you are distributing to your capital provider in the form of cash, and the amount is 15,000. So, it is recorded under debit side. Now comes debtors. This entry has been taken from journal. If you remember, under journal you had sales, and sales you did it not in lieu of cash but on credit, right? So, what has happened? Somebody owes the money to the company. So, that is the asset of the company, because company can ask that person this much money anytime depending on the terms of the sales. So, this is also a part of asset. Now, increase in asset you record it under debit side. So, accordingly it has been recorded. Now, we move on to next from the journal entry, sales. Now, if you remember, sales is nothing but income, and increase in income is recorded under credit. If you look at the convention that I introduced to you in previous lectures, as well as briefed you in the beginning of this particular lecture, in that you find that increase in income is to be recorded under credit side, and same it has been done here in this particular slide also. Now, look at the depreciation, it is an expense. Now, increase in expense you record it under debit side, and accordingly you can find an amount of 6,000 has been written under debit side. I will send you these slides today, so don't worry even if you are not able to copy it. Now, next comes accumulated depreciation. Depreciation is an expense, but accumulated depreciation is a liability. Similarly, wages is an expense, but accumulated wages is a liability, because the company owes it. Whatever wages gets accumulated, the company has to pay them sooner or later. So, it is a liability. So, you find that wages, which is an expense, is recorded under debit side, because increase in expense you write it under debit side. Now, if you look at accumulated wages, which is shown next, or accrued wage also it is known as, it is a liability. Increase in liability you record it under credit side. So, as far as step 4 is concerned, we are through. What we have done in this step? We have transferred all our cash related entries as well as non-cash related entries into different T accounts. We had as many T accounts as the number of heads involved in the transactions. Now, what we do? We prepare an initial trial balance. Now, how it is done, I will show you with the help of the example of some T accounts which we took right at the beginning. For example, if you look at the capital T account, look at the capital T account. This is what we did. Now, what you can do from here onwards, this next step I will write it in different color. Now, you find that there is a difference here. 300,000 is under credit, but there is nothing under debit. Now, accountants will be quite unhappy with this. So, what they do? They immediately write balance carried down. And how much would be the amount? It would be equal to 300,000. So, total here also would become 300,000. Now both sides are matching. Now just because we entered balance carried down here, just to balance it, we will try to bring it down here, and that is how it is written like this: balance brought down 300,000. So this exercise is conducted for all the T accounts as on the date at which you want to prepare the profit and loss account and balance sheet. This is also known as closing of T accounts. So what we do here? We look at the debit side and the credit side. Whichever side has got some, whichever side is unbalanced, we try to add a balance carried down figure there, and then which is brought down to the other side of it. For example, if the balance carried down is under debit side, balance brought down is under credit side. Had this balance carried down been under credit side, we would have brought balance brought down under debit side. We will see some more. For example, we move on to bank loan. Here again, accountant should do like this: balance carried down 400,000. So the total becomes 400,000, and here they will write balance brought down 400,000. So the bank loan is closed. Bank loan T account is closed. Right? Now we move on to one more so that the process becomes very clear to you. We had building T account. I will do it again. Building. It's an asset. I had debit here. I had credit here. I had on 1st of August in the form of cash, I purchased this particular building, so increase in asset, and I had recorded it under debit side. This is what I had done. Now what I will do, since there is a mismatch here, total, if you see, total is 100,000. So there is a mismatch, so I write balance carried down 100,000. So here you have balance brought down 100,000. So this exercise is performed for all the T accounts that we have prepared. So for all the T accounts, please try to do this exercise as part of preparation of initial trial balance or step 5. So using this particular process, what I have done, I have prepared the initial trial balance. So if you look at the capital which we did just now, it is shown under credit side 300,000. Bank loan, when you closed the T account, you got a balance brought down value under credit side, so it has been recorded under credit side. Likewise, for most of the other transactions, other T accounts, the entries are under debit side. For example, for cash it is 122,000, for building it is 100,000, for equipment it is 250,000, for furniture it is 50,000, for purchases it is 150,000, for interest 4,000, and income tax 9,000. Now some of you may have some doubt. I will try to do it again. For example, what we did in previous step, was to close all the T accounts. Now suppose, for example, we close the T account capital. We got a balance brought down figure of 300,000 under credit side. So whatever balance brought down was there, we need to bring it to initial trial balance sheet. So if you look at this particular trial balance, it shows under capital an amount of 300,000 in credit side. For example, if you just see here, capital, this balance brought down value, you may note it is under credit side. So while preparing the initial trial balance, this will go under credit column. Now if you look at building part, balance brought down value is under debit side. So in initial trial balance under building, it will go under debit side. So this is how the process has been completed and initial trial balance prepared. Now look at this particular slide. You will find that for cash, which I told you that cash T account is nothing but the cash book itself. So if you remember, we had got balance brought down on the debit side. So that is what has been shown here. I will just try to take you back. Look at this slide. Where is balance brought down position in this particular slide? It is under debit side. And what is the T account or the cash book? It is cash T account. So for cash, when I enter it into initial trial balance, I will put it under debit side. Is it clear to you now? Wherever you notice the balance brought down, the same thing is recorded under initial trial balance. For example, for capital, we had a balance brought down figure under credit column. So here also 300,000 you can notice it is under credit column. Now if you try to recollect bank loan, there also we had a brought down figure of 400,000 under credit side. Accordingly, it has been shown in credit side. Now if you look at the building, when we close the T account, balance brought down was under debit side. So accordingly 100,000 is shown under debit column. Likewise, after closing each of the T accounts, I bring the balance brought down value into either the debit side or the credit side. Some more are given in the next slide. For example, dividends. When you close it, you will find that the balance brought down of 15,000 is coming under debit. Debtors, 120,000 balance brought down is coming under debit. Sales, 120,000 under credit. Depreciation, 6,000 under debit. Accumulated depreciation, 6,000 under credit. Now if you total the debit column as well as the credit column, you find that both sides are matching. Initial trial balance total value is 878,500 under debit and same amount under credit. So how we have reached up to this stage? Step 1, initiated the transaction. Step 2, recorded the transaction either in cash book or ledger, journal. Step 3, we had a provision for adjustment entry. Step 4, what we have done? We have transferred all the cash book as well as journal entries into different T accounts, and in step 5 we have prepared the initial trial balance first by closing all the T accounts and bringing the balance brought down values either in debit side or in credit side. This is what we have done till now. Step 5 is done. Now we move on to next. Our aim is now to prepare the profit and loss account, right? Now profit and loss account, if you try to recollect the informal accounting process, what it used to give you? It used to give you what is the sales that you have achieved, how much expense you have incurred, what is the profit that you have made, and out of that profit how much is going towards taxes, how much is going towards dividends, so how much is your net profit. In a general sense, this is what we did in informal accounting. The same thing we try to do it in a little different manner, in a slightly systematic manner. So what we do, as of the date on which you want to prepare the profit and loss account, you try to take a stock of your raw material, your work in progress, the stock of finished goods, how much purchases has been made, and in addition to this you also see what are the revenues that you have generated and what are the other expenses that you have incurred. So all these things from the initial trial balance will be part of your profit and loss account. That means, in other words, we are concerned now with revenue and expense part. Besides this, we also want to take a stock of our raw material, our work in progress, and our finished goods stock. So for this, we again need to record them in journal first, because journal is the record of first entry. So we must have record of these transactions, adjustment entries into journals first, and then they will again be posted to the respective T accounts, and those T accounts will be closed, and then finally you are having a profit and loss account. So you can see stocks of raw material. This data was given to you that as of 31st August, 50,000 is the stock. It is recorded in debit side. Now this will be transferred to profit and loss account. That's why you may notice P&L written over here. Similarly, work in progress also you want to transfer it to P&L. So you will find that it is quite a systematic process. Whatever is the transaction, first the relevant ones are closed, the balance one is transferred to some other. From that balance one, they are again taken to journal. From journal, they are taken to ledgers. Ledger entries are closed and they are transferred to finally the balance sheet. So this is what has been done. So we have recorded a journal entry of J4, J5, J6, J7 and J8. Now you will find that there are some more entries, for example, related to income tax, related to sales, related to depreciation and related to wages. Now these are posted according to the convention that we have adopted. Increase in expenses are to be recorded in debit side, increase in liability is to be recorded under credit side. So likewise, if you just try to see and notice these values, whatever has been entered into this profit and loss account, you will find that these are items concerning revenue and ledgers, revenue and expenses. Besides this, information on raw material stock, the work in progress stock and the finished goods stock. Just to summarize what we have done in this particular last step, we are trying to take out those items which are related to revenue or the expense. And in addition to these, we are also taking out the items such as raw material stock, work in progress stock and finished goods stock. Now accordingly, journal entries are made based on our signed convention. For example, you found that the increase in expense has been recorded in debit side and increase in liability has been recorded under credit side. Now these journal entries, whatever we have made just now, J4, J5, J6, for them we also need to have the TAccount entry, right. Now these slides already we have discussed, in which I have told you how to close the TAccounts. So already this has been discussed. Now if you look at the TAccount which we have just created in the form of journal entry J4, J5, J6, corresponding to that you can note down the TAccount. For example, earlier we didn't have stocks of raw material TAccount. Now if you look at this particular slide, you have stocks of raw material TAccount. So you find that it is going to profit and loss account under debit of 50,000 and balance carried down is 50,000. Similarly, you have stocks work in progress. These are created now. These are nothing but the adjustment entries. You do it only when you want to prepare the balance sheet. So that's why in the beginning we didn't have these TAccounts. Now we are creating the TAccount and we will subsequently close them. So you have stocks, work in progress, stocks, finished goods. Then here is the profit and loss account. Here again you find you have a debit side and a credit side. Now depending on the balance brought down values, the different journal entries are recorded either in debit side or on credit side. For example, purchases is recorded under debit side, amount is 150,000, wages 52,500, depreciation, interest, income tax, all recorded under debit side. Now if you look at the credit side, there are sales, stocks of raw material, stocks of work in progress and stocks of finished goods. Now just after J9, if you see in debit side, I have entered a value profit. Now profit is the difference. It is nothing but the balance carried down, right? Because if you try to sum it up both in debit side as well as in credit side, you will find there is a difference of 21,000. So that we used to take care by writing balance carried down. Now here in profit and loss account, this balance carried down is nothing but your profit. So profit has been taken as 21,000 and now you find that both sides are matching. Total under debit side is 242,500 and under credit side it is 42,500. Now since there was no TAccount for profit, we have to create them. But before creating the TAccount for profit, we need to enter them into journal. Because remember, journal is the first entry record. So you will find journal entry has been made as of August 31st, profit and loss appropriation, then dividend and retained earning. These three journal entries are made as of 31st August. When you talk of profit and loss appropriation, it means how the company has decided to share the profit. how much part it wants to keep it within itself as part of retained earning, and how much profit it wants to share it with the stakeholders in the form of dividend. So, this is how it has been recorded under debit and credit side, and now these things again are to be taken to T accounts, respective T accounts. Now, from profit and loss appropriation value, you will try to see the last line J13. Now, the profit has been replaced with profit and loss appropriation. Earlier this entry was written as profit and there was no journal entry corresponding to that, but now we have a journal reference of J13. This you please note it down, and this is shown under profit and loss appropriation. So, 21,000 profit and loss appropriation has been made. So, you find that the total still remains at 242,500. So, there is not much difference. Only thing what we have done is profit has been replaced with profit and loss appropriation. Earlier we had written profit because we had no journal entry for that. We created a journal entry, and from that journal entry I have brought it to the profit and loss account. So, this is as far as the final profit and loss account is concerned. Now, the next task is to create the balance sheet. For that, we need to close the T account as far as profit and loss appropriation is concerned, dividends is concerned, and retained earning is concerned. So, you will find the same principle has been used to close this. Dividends 15,000, retained earnings 6,000, profit and loss total is 21,000. So, it is closed. Similarly, dividend you find it is taken from profit and loss appropriation and it is closed. Then retained earning, again it becomes liability. So, increase in liability you find it is recorded under credit side. So, what we have seen here is we have now closed all the relevant T accounts, and then we prepare the final trial balance as of 31st August. This is the prerequisite of preparing the balance sheet. So, the same principle I have followed. Cash, there are very few changes. Now, you will find that the revenues and expense items, they will not be appearing here because they have already been closed and taken to the profit and loss account. So, now in this particular final trial balance you will find mostly items concerned with assets and liabilities. For example, you have cash, capital, bank loan, building, equipment, furniture, debtors, accumulated depreciation, accrued wages. Now, all of them either belong to asset or liability. Now, contrast this with the previous trial balance. There we had whole lot of things: assets, liabilities, revenues, expense. All of them were there. Now, out of that, revenue and expense related accounts were closed and finally taken to profit and loss account. From profit and loss account we took profit, we distributed it as part of dividend and as part of retained earning, and then we are trying to come to the final trial balance. Now, you will find the total is coming to be 764,500, both in debit as well as in credit side. Now, based on this, we can prepare the final balance sheet as of 31st August, which is, you can find building is having 100,000, equipment 250,000, furniture 50,000, gross fixed assets 400,000 is nothing but the sum of all the three above: building, equipment, furniture. If you add it up, these are part of your gross fixed assets. Now, in this I subtract the accumulated depreciation. This value was given to be 6,000. So, my net fixed asset as of 31st August becomes 394,000. Now, stocks of raw material is available with me for a value of 50,000. Now, this same thing has been consolidated here. You can see it starts with net fixed asset valued at 394,000, raw material stock 50,000, work in progress stock 32,500, finished goods stock 40,000, debtors 120,000, cash 122,000. So total asset is coming to be 758,500 and total liability is coming again to be 758,500, which is including capital, retained earning, bank loan, accrued wages. So what you find here is that it is quite a systematic process. Since our background is not that of accounts, although the process may look tedious to you, but once you are accustomed to follow this particular practice, it is not a difficult task. Only thing you have to see and follow these 5 steps, 7 steps very systematically. You start with recording the transactions, initiating the transactions, record it either in cash transactions, non-cash transactions. Cash transactions you record in cash book, non-cash transactions you record in journals. Then you record adjustment entries, you start closing it and prepare the trial balance, initial trial balance. From this initial trial balance you take out the revenue, expenses, stocks of raw material, work in progress, finished goods separately. You will get the profit and loss account. You calculate whether you have made profit or losses. That profit you appropriate it, that means you distribute it. Maybe you may distribute something as part of dividend, something you want to keep it as retained earning, that will be your liability. So this retained earning will be part of your balance sheet, right? Now from the initial trial balance you take out those items which you have already closed, right? So you will find that you are left with assets items and liability items, and using these assets and liability items you prepare the final balance sheet. So this is in nutshell the total formal accounting process. I know there have been some interruptions in between. I didn't stop this time because I had to complete it today somehow. We will try to send you this DVD very quickly so that you don't miss it. And I would like to invite you for any questions or queries that you have. No question, no queries. Thank you. Did you understand? This time I had to go in a little